Hi, this is Harry Dent with an update on May 11th. After the May 6th mini crash, we've got a lot of questions, and of course they are, hey, is that it? Is what you're finally saying about a major crash in the markets, is it starting to happen with this whole concern over Greece and European debt and the whole maybe some errors in the marketplace? And our answer is no. In our May issue, we clearly said we expected another substantial correction to come in May, but our technical indicators, how we measure the bearishness and bullishness of investors at different levels, that is very key to short-term trends. It's very different from what we do in our books and our longer-term forecasts with demographic and technology and commodity cycles and other things. But our indicators are telling us that this market has not topped in April, and we were forecasting in May, again, a correction about of this magnitude and a final rally into late June, late July, maybe early August at the latest. So we are seeing a peak in the markets between a Dow 11,300 on the low side and 11,800 on the high side, and between late June and early August. We'll obviously have to narrow down on that as we get more readings on how this rally resumes, as we assume it will. But that's what we're saying. So we're not saying this is coming yet. And it's important to understand for people that follow us that we do use very different indicators in our newsletter and looking at shorter term trends. And in a time of volatile markets like this, if you are not looking at these indicators, if you're not, in other words, acting like the smart money, because that's what we're really doing here, tracking what the smart money is doing, really about 1% of very sophisticated investors versus the broader groups of investors. The smart money makes money short term by doing the opposite of what you and most people do as investors. That's why we track them. They are only starting to sell at this point. They sell several weeks and often many months into a rally before it peaks. So we're just getting signs that this is happening, and we will be monitoring this in our newsletter over the next few months. Now, what is going to cause this, we see, as likely a sudden crash, because we do see it happening similar to what we just saw. I mean, May 6th, that Thursday, when the market dropped 1,000 points, 700 points in a matter of 15 to 20 minutes, you've got a lot of highly leveraged hedge funds and what they call high-frequency traders in this market more than any time in history. One of the things we stressed in the paperback version of our book was that the largest component of $102 trillion in total debt, counting unfunded liabilities for Social Security and health care and everything else, the largest single sector is financial sector debt. 17 trillion, more than our entire government debt, more than all consumer mortgages and debt. That is just leverage and investments. So what happens when you get something like this, some bad news happens, a lot of these hedge funds get margin calls and they just are forced to sell. The analogy I've been using for the last year is that the oil market, how it melted down in just 4 months, it went down 78% from $147 to $32. I have never seen any market go down that fast in my entire 30 years of studying the markets. I think that's going to happen in stocks. The stock market is in denial. First, we said in our April issue, in May issue, they're in denial about the Greek and European debt crisis. Well, they're not now. That 1,000-point crash was all about the markets going, oh my gosh, there is a problem here. And that forced the European Union and the IMF to make some very strong responses. But what is this? Another $1 trillion in Band-Aids. The real denial here in the markets is about the extent of debt in the developed world. The real estate bubble has crashed just like it did in Japan. In Japan, prices crashed 63%, and they're still that far down 20 years later. Real estate is not coming back. The banks are betting on that. The government's betting that if they can stimulate the economy, not only will GDP come back, as it has, but real estate will come back. We've been showing in our newsletter and some very key indicators, we don't care about home sales, we care about home prices. They're barely bouncing despite this dramatic recovery. Home prices don't come back. The banks are in trouble because banks are way underwater in their mortgages, and so are homeowners. That's the key indicator, and they're not coming back. So what we're going to see later this year is that banks have been holding off on all their foreclosures from defaults. We've been tracking our newsletter that we're continuing to see serious delinquencies in defaults occur, and those lead to foreclosures on a one-year lag. Mortgage resets for the riskiest mortgage are going to surge again, just like they did in 2008 and early 2009, July, August, September, October. Next round of defaults, banks are going to realize, oh my gosh, housing's not coming back. This thing's going to melt down, and you're going to have foreclosures hit for years to come. So this banking crisis is not over. The housing bubble is not over. We're going to see housing go down later this year. This is going to precipitate a crash in stocks, since the markets are so in denial when this finally hits them, that this recovery is going to fail and the government stimulus is not going to turn this around. The markets, we think, are going to crash very rapidly. We could see as low as a 3,800 Dow by December of this year. And that's after the markets go as high as 11,800 as late as, say, late July, early August. That's the type of scenario we're looking at. So we are warning you now, but we're also warning you this does not look like it's over. Our technical indicators are clear. We are probably 2 months away, give or take, from a top. We're probably going to see one more rally. Now, another danger sign we think that could trip the market somewhere between July and August, and that's our big danger time for turn point, is that we think second quarter GDP is going to be very disappointing. First quarter GDP was mildly disappointing, as we warned it would be. Second quarter GDP, we think consumers are going to really start to slow, particularly after the stimulus and the housing credits disappear after April. We think consumers are going to slow. We've got some indicators in our newsletter that show that as well. So we get these defaults, we get disappointing GDP, and then the last thing to fall, China's in the biggest bubble of anyone. We covered this in our April newsletter. China is building cities like Ordos, 1 million people, totally built, no one there, just like I saw in Dubai a couple of years before that collapse. I was just in India. India and China are both having to slow their economies. They're the opposite of us. They're not going into deflation, they're in inflation, and they're having to slow their economies. Real estate's going up too fast. Food prices up 18% in India. So we see the whole thing, a global downturn. Everything looks fine now. The economy keeps rebounding. Everybody keeps getting convinced. The market keeps going down but keeps making new highs. We're saying between July and August there's going to be a major turn, and if you're not out of the markets, it could happen so fast that you don't have time to get back out. And real estate, after bouncing a little bit and loosening up here some, real estate's going to turn the other way later this year, early next year, and you know how illiquid real estate gets. So that's our warning. We're saying it now. It's not over yet. As we said in May 1st in our newsletter, we're going to look in our June newsletter at how this $17 trillion, where's that in the financial sectors? That is the nastiest and the most toxic of the debt, and that's going to trigger this next downturn when everything fails. The government stimulus program, we said it from the beginning, it is not going to be sustainable because demographics are working against it, and debt will continue to deleverage. So be on alert, and we encourage people to get on our newsletter now in the next few months, because we think the most important times in the markets are going to occur in the next 3 to 6 months, and the worst of this downturn in the next 2 years or so. Thanks for listening.